Hello, everyone, and thank you so much for joining us here on what I hope is now your favorite podcast, Armchair ESG with Nate and Yates. I am Rob Yates, Director of Communications for OWL ESG. With me, as always, my partner in crime, Nate Geraro, head of our product here at OWL ESG. How you doing today, Nate?
Doing great, Yates. How about yourself? It's a Friday.
No complaints, man. It is beautiful weather here in North Carolina. I hope you are feeling the same.
Yeah.
And on today's episode, we have, again, a very special guest with us. Nate, would you do the honors?
Yeah, we have Conor Platt, who is the founder and CEO of Confluence Analytics. So we are going after the heavy hitters for you guys. So happy to have him on board and excited for this conversation.
Thank you, Nate and Rob. Excited to be here.
Oh, that's awesome. Thank you for joining us. How you doing today, Conor?
Very well. It's a sunny day here in Pittsburgh, Pennsylvania. And happy to be here.
So it sounds like it's beautiful all across the United States. So we have a lot to talk about. You and I worked on an article that we put out last week. Bunch of interesting stuff today, hopefully talking about different scopes of emissions, carbon pricing, offsets. But before we get into the technical stuff, you tell us a little bit about yourself. Who is Conor?
Yeah, who is Conor? So I'm Conor Platt, Confluence Analytics. I've been involved with markets since leaving school at Carnegie Mellon. I've worked at Morgan Stanley in New York and Brown Brothers Harriman in New York. And then my background leading up to this, I've been involved with starting a emerging manager long short fund. I've co-founded a company called Etho Capital that launched the best performing ESG ETF. And Confluence Analytics is really about first, it was about making ESG more actionable. So taking data and really tying it to risk, and we can talk a bit about that. And what we've been working on in addition to that is really what we're going to talk about in this article is this notion of building portfolios and integrating emissions and offsets into those strategies. And I think it's one of the keys to unlocking sustainable investing for the mainstream.
So that's awesome. Something Nate and I have talked about on this podcast before is that if we really want to see some change in this world, and when we say change, sort of a change in direction, it's got to be market driven. So it's really exciting to work with you to jump into this. So as we get into this, just give us a little more background on exactly what Confluence does.
Yeah, sure. So what we do, and we're a customer of OWL and very happy to be part of OWL. We've been involved.
We're glad to have you.
Yeah, building products, and we've been a long-time customer of OWL. And we've worked with all the data providers in the past in various efforts that we've done, and everybody has their own positives and negatives. OWL, as I think people know, really allows you to have a good starting point, a really clean starting point. And what we do is take OWL data and then residual stock returns. And what that is, take any stock you want, Apple, for example, and you can look at Apple's returns and break down and attribute all those returns to various factors in the marketplace. And there's always some residual return that's quote unquote unexplained. And what we really do is we take a factor-based approach to ESG investing where we say ESG data needs to be married with residual returns to make predictions of the future. And admittedly, ESG, if it's a factor, is a small factor, but in the game of investing, and we've all been in it a little too long, in the game of investing, it's a game of inches. And it's a game of between A and B. And in many cases, this is just another piece of data that can integrate into a process. So that was what we do and what we do every day. We develop signals with various ESG and carbon inputs and develop models and model portfolios. So that's how we put it together, and I'm happy to talk more about that. And we have stuff on our website that sort of demonstrates the process.
Yeah, Conor, that's awesome. And looking forward to getting into some of those details because I think a lot of our listeners will be very interested in that. You mentioned that, you are a client of OWL, but can you give us some background of how you came across OWL?
Yeah, sure.
You got connected?
Yeah. Yep. Well, a couple different ways. So an investor of ours and a longtime colleague knows both Ben and I and suggested that we meet. Ben and I have both been in the ETF world, and in various ways. That's as Ben has already explained, that's kind of how Owl Analytics started, as an ETF venture. I've also been in the ETF world. It's a very interesting world, and in meeting Ben and in what we were trying to do, Owl was the best solution. We were trying to take something and build on top of it to make some clarity. What Owl does a great job of bringing that consensus view and allows you to build on top of it. Very similar to literally the entire or most of the investment process that we were involved in at Brown Brothers Harriman was driven by earnings analysis. And earnings analysis starts with a consensus view of the some odd number of analysts on any stock or industry. And we've taken that approach combined with quantitative analysis to get to actionable data.
So that's awesome. So following up on that, and this is a question we've been asking everyone who's come on, something that we've talked about and putting it in context for the listeners, but something that certainly you and I have talked about, sort of the hotbed political environment around ESG, which we've made the argument that it's not that there's nothing to it. Sometimes it's that it's myopic. So with that as a lead in, and not to try to steer you in one way, but I've learned a lot from you talking about the quantitative side of it. But before we get into that, just on a broad level, what does ESG mean to you?
Well, yeah. So what ESG means to me first as an investor is that it's a data set that's very misunderstood. And in 2014, 15, when I was looking at this with some partners, it was clear that carbon footprinting as a proxy for supply chain actually kind of made sense, because there's actually not a lot of great data on supply chain efficiency anyway. And so you have to get creative. I would also say that, and I was just literally looking at this the other day, I started on Wall Street in 1999. That's often said, and I believe it, when you start on the street is somewhat informs your investing world. It certainly has informed mine. And I think that the view is that you just have to be always looking for things that are tied to change. You also have to look at just the composition of the indices today. And if you look at the top 10 holdings of the S&P 500, they are mostly intangible assets and services and brands. And it may be imperfect in terms of the ESG data with that task, but financial data is not particularly great at ferreting out brand and intangible assets and positioning. And it's just also been the case that investing, at least on the producing part of it, is getting harder and harder. People are demanding more for less. And I think that, it's just an evolution of investing. Everybody has the financial data, basically. And in fact, there's regulatory mandates that enforce that. So you're always looking to the next thing. And it happens to be the case that people do label ESG as marketing. And let's say it is a form of marketing, and what it's marketing towards is to shareholders, customers, and future employees. And it's hard to really, you can weight it differently, but it's hard to ignore it. The notion that, and I've loved it, taking politics out of the boardroom while we're talking about bailouts. I mean, give me a break. Give me a break. So, and it goes both ways. I mean, we are transacting with US dollars. It is political. So it's a component to the strategy. What's also happened is there's now a social, environmental, and governance component to this. And it's another weighting. It's very exciting to me. It's fun to see. It's been fun to be part of this when people completely ignored it, and now it's like the cause of all the problems. So it should be fun. But taking politics out of the boardroom That would be interesting. That would mean that politicians couldn't trade stocks. And we know that that's something that they like to do. So, you know, I'm all for it. I mean, the more the better. People should know at home that there are Wall Street portfolios run off sunspots. There are Wall Street portfolios run off all kinds of crazy inputs that people do. Now, do they talk about it? No, but huge amounts of money are run on esoteric factors. And we in the investment community understand that that goes on. So, you know, the rest of it is just part of the party, I'd say.
So that's actually another really good segue. So we worked on an article. It came out 2 weeks ago now. Well, last week. The article was called "The Case for Ignoring Scope 3 Emissions," and I wrote the words. You did the work to back it up. We've been promoting it a little bit, and I would really love to get into what we talk about in the article, but I'm going to bring up this graphic. Before we dive into that, I'm hoping you can explain to everyone just a little bit first what Scope 1 and 2 and 3 emissions, and then we could talk about what the difference is between them in terms of looking at it from an investment portfolio and measurements.
Sure. So for those looking at the screen in front of us, Scope 1, 2, and 3 emissions, and this is all related to public equity, global public equity companies. All companies, all endeavors produce some type of emissions. Public companies have been submitting their Scope 1 and 2 emissions, which we'll define in a second. They're now mandated to do so, but in terms of the S&P 500, it's been more than 80% for over 5 years submitting Scope 1 and 2 emissions for the largest companies in the world. Scope 1 and 2 emissions are the direct and indirect emissions associated with the company. So that is all direct emissions, and depending on the industry you're in, if you're obviously in an extractive industry, your Scope 1 emissions will be higher. Scope 2 is all the activities related around the business, travel, operations. It's, you know, all the operating capabilities of the business. And Scope 3 is the supply chain of a business. And as we've kind of talked about, supply chains is another aspect of the stock market that has changed dramatically over the time that we've all been on the street. In fact, you know, Apple would be an amazing example of a company and a supply chain, and it happens to be one of the largest companies in the world. So Scope 3 is all of the supply chain to produce a product, and then the subsequent emissions of that product in its life cycle. And so we are going from a world of actuals, where a company is stating, you know, their operating expenses and their inputs and all of that, to a world of estimates and actuals. And so Scope 3 is a real thing, but there's a lot of variance in the estimate of Scope 3 emissions depending on the model that you use. And I'd say that the acknowledgement of Scope 3 is, you know, obviously well understood that these things exist, but an exact number and an illegal mandate around that number is definitely more elusive.
Yeah, that's great. I think you explaining the difference of Scope 3 and how difficult it is very helpful. I think that, you know, most people understand that and why the variances are there. Right before we got on this call, Conor, you were telling us that, you know, Scope 1 and 2 really is a commodity data set or commodity data sets, right? They've been around for a while now, right? They're you know, pretty standard across the industry. But you did make a point of that's great, but what do we do with it? You know, what can we do with it? You know, what's the benefit of having all this data out there? How do you make that actionable?
Right. Well, a couple different ways. So, you know, taking a step back, we I have used scope 3 admissions in an investment process, right, to as a proxy for supply chain efficiency. And I would say if you're comparing companies within their own industries, that's a great method, no matter what the model is. The reason scope 1 and 2 are becoming a commodity is one, the SEC is mandating it. Number one. So, and number two, effectively, these companies have been filing this for more than 5 years. And I don't have the exact number, but if you go to various third-party open source carbon databases, you will see that scope 1 and 2 admissions are generally available, and you could scrape them even. What would you do with them? Well, what we would do with them is a couple different things. And we'll talk about this graph in a minute and kind of bring it back to the point. You can certainly use it as an input to models. So we use scope 1, 2, 3, and changes in those emissions in our carbon models. What we've seen over the years is that it's a very good indicator. It just has a lot of volatility. I'm going to move my cat off my table here. The scope 1 and 2 admissions, again, you can use it as an input to a process. We are also saying that scope 1 and 2 admissions allow us to say, how can we bring a portfolio and make it more net zero? And essentially, is there an efficient mechanism or market to offset the scope 1 and 2 emissions that we're certain are happening in any combination of portfolios? Now, what this chart is showing you is the US large cap admissions from about 2019 to today, both scope 1 and 2 and scope 3. And an important inflection point in the data that we're using, and I think you're going to see this across all the data providers, happens in the year of 2021. And what you're seeing, for those who can't see the picture, is essentially a downward decline for both scope 1 and 2 and scope 3 admissions of the portfolio. And this is driven in part by efficiency measures, but in large part, at least in the US, in composition changes within the portfolio. Around this point, there's also around the peak of the market in 2021, technology was roughly 30% of the S&P or Russell 1000 index. And it should be known to people at home that technology, while it's the biggest market cap sector, is one of the lowest sectors in terms of admissions, both because of just the nature of their business and in terms of their focus on being more efficient and on being greener. Most of the admissions, whether it's scope 1 and 2 and scope 3, are coming from 3 or 4 sectors. And those sectors are energy, utilities, materials, and to some degree, depending on how you measure it, financials. Consumer discretionary also is a big one. In all those cases, what you're seeing is this compositional change, efficiencies, and then you start to see a leveling out of scope 1 and 2 for the last, call it, year and a half, and a ever increasing rise in scope 3. And generally speaking, what I think we're seeing here, and I think we're going to be seeing it all over the place, is that the scope 3 models, because scope 1 and 2 is a commodity number and will certainly on a going forward basis become one. Scope 3 becomes the number that is more interesting and perhaps more impactful, but also the number that we'll call it the model wars can play. And what you're seeing here from an investment management standpoint is actually not so great for investment managers, which is a real focus on changing of models of scope 3 data. Perhaps they have, and we've talked to these folks. So it's updates on models, it's updates on numbers. It's all very good things. The problem is they didn't do it back in time. And if you don't do it back in time, it becomes very difficult to become an investment signal. And that's not, a controversial statement. It's just a reality. Whereas, and so with scope 3, you can see that there's a lot more model estimates than actuals. Doesn't mean that it's not a worthwhile pursuit, and many companies are going to go down that route because there's a lot of efficiencies and other gains to be made in their supply chain. In fact, perhaps supply chains generally will have more emissions because they're coming on shore, and there'll be more measurement around that. I mean, in large part, many of the corporations, this is also feeding into this factor, but this is also a change in model behavior, and it makes it less predictable in terms of signals. There's another type of criticism to scope 3 that pretty established sustainable investment manager put out there, Osmosis, that folks can look at, where they're stating that, if you just construct portfolios with scope 3 alone, you end up having a lot of kind of low revenue companies, effectively very growth companies, and it skews that way. It's.
Oh, that's a great explanation. Just a really quick follow-up question. Do you see out in the future where scope 3 modeling gets a bit more standardized, or is it still a bit of a wild west, type of, I don't know if that's a great characterization of wild west.
No, it's a great question.
Yeah.
It's like everything in ESG. There's 4 or 5 people with 4 or 5 standards. Eventually there'll be 2, and then eventually there'll be 1. They'll, without a doubt, by industry, by sector, there are groups getting together and trying to standardize this and bring efficiency. But at equal measure, a supply chain is a strategy. And as we see supply chains come on shore, there are probably more people than I could ever know looking at various models and strategies within supply chains. But it becomes this question of scalability in terms of data. If you have a great model on a company, fantastic. That's actionable on a company level. We try to look at things more at market sector levels. It's not to dissuade anybody, and not that I would. It's just more as an input to an investment process. If you have too much variability across providers, it becomes noise, right?
Yep.
And so over time, without a doubt, scope 3 will have various forms. And I would think scope 3 might really go down the path of being much more sector industry focused, because it's so specific, and the models and the assumptions are, pretty granular. But I don't think that they'll ever stop being very, very complicated models around supply chain. And generally speaking, over time, consumers are beneficiaries of cheaper products.
So that's, because I do want to jump into the article a bit more.
Yeah, absolutely.
And the article is called "The Case for Ignoring Scope 3 Emissions." But that's not really what we're doing per se. We do list a couple other practical difficulties with scope 3. One is that they're simply harder to measure because it's supply chain. So outside of all the modeling, the investment aspect, just for a company to understand the full emissions of a product life cycle can be tricky. And the other one is there's overlap. So if you're using another, say, Russell 3000 company as your transportation company, for example, their scope 1 and 2 emissions are part of your scope 3 emissions. And so we get into what it really is the case for using scope 1 and 2 emissions in pricing models, which is what I really dive into. But before that, because we're going to start talking about offsets to some degree, and we're going to start talking about carbon pricing. So can you explain simply what an offset is, and then what issues have we had with trusting offsets in the past and how they've mostly resolved recently?
Yep. So generally speaking, just super high level, an offset is a project that is doing something that is either removing carbon or absorbing carbon. I'm going to stick with carbon here. There's lots of different types of offsets, but carbon offsets are projects or activities that are actively reducing or mitigating carbon in the atmosphere. And the way that, and this has existed for over 25 years, and the way that it started was essentially similar to a bond, if you will. Essentially, you're buying into a project, it's issuing credits each year. Those credits generally are for 1 metric ton of carbon. And the point would be to buy those credits and retire them to offset whatever carbon or activity you're doing. The issue that has come to pass today is that those projects, this is pre lots of types of technology, those projects had assumptions in them of the type of mitigation that they would have. And they, like all projects, they're 10 to 15 years long. And so essentially you as the buyer of those carbon are buying a promise of offsetting. And at the end of the project and throughout the project, there's audits and different levels of efficiency, but it's really only at the end of the project that you get a full sign off on how effective this really was. And that has led to, along with every other problem that has happened in every type of sustainable market that's existed for longer than 20 years, all kinds of different problems, issues. John Oliver did a great, skit on how carbon credits work and all that. The reality is that what started to happen is that the original concept is right. What needs to happen is have a lot more technology to allow better auditing of the activity. And so what we have now, beginning and ongoing, and there's different types of projects as well. There's projects like cook stoves, that a great friend of mine is involved in, done very well with the notion of, rather than have people cook inside their house with charcoal, you create solar cook stoves and they can cook outside, and the health benefits are, unbelievable. But also, and importantly, all of that cooking and can be measured and put back in the project. So the people buying those credits for that activity have surety that the activity is actually happening. Which is a lot of what's going on. Is you're creating an incentive. Are you getting the action that you're intending to have? And that's ultimately what the criticism of carbon credits has the action matched up to the price? What's happening now, putting aside all the other stuff, is what's happening now is that essentially between a standard setup would be a satellite, some measurement on the ground, and some kind of registry, perhaps a blockchain.
I was going to say, because this is fascinating, can you give a little 60-second detour on the blockchain aspect of tracking it?
Well, so the blockchain aspect of tracking this is that it is an immutable registry. And essentially what you're trying to do is say that you have a project, it has these variables coming in, meaning this activity that's verified by a third party, and that it can be put on the blockchain, and everything can line up. And you don't have to believe the issuer, because the issuer is having a third party submit data that says that this project is in fact doing what it says it's doing, and at this level of efficiency, just like any other financial asset. And up until this point, those things weren't really in play. Now, the way it works traditionally is there's a carbon registry, and there's numerous carbon registries in the world, some that are known, things like Vera. And essentially, each project has a very detailed methodology of how they are improving the world and how they work and how they should be measured. And there's a whole audit process each year or in some known time period to verify that these projects are in fact doing what they say they're doing. We would say, though, that like all markets, the carbon markets have existed for a long time. And there's been dramatic improvements within commodity markets generally. And this is a particular market where blockchain actually, or something like a registry, is a central point. And you have seen any number of startups try to launch digital carbon registries. It's a little harder than it appears, but like all things. But the end result is something actually kind of amazing, I think, for sustainable investors going forward. And what it is we've been talking about this scope 1 and 2 emissions, and we're saying that it's pretty indisputable, the numbers of what they are. We are talking about a better, more efficient carbon market where you can price something and execute it, importantly, in a systematic way at a level where carbon offsetting becomes a capped basis point expense. And so since we sort of started this conversation off as, hey, we're all sort of ETF guys, we sort of live in a world of delivering something at an all-in-one product number price. And what digital carbon allows for is the ability to efficiently offset scope 1 and 2 emissions to a 100% level or to a 50% level, to a level that would match your target of actually hitting these sustainable goals. And you can't be net zero without some action. You can't create portfolios with negative emissions. It's impossible. Trust me. So, and actually it should make sense that it's impossible, because you as an investor are giving your capital for it to grow. And it's impossible for that capital to grow without there to be some emissions involved. It's impossible. So even if the companies involved their mission is to improve the emissions of the world, it takes some emissions to get somewhere. As Rob and I sort of joked, and it's the tough part, it's that, emissions are the cost of being green. And so you almost have to think of it in the reverse of how I guess it's being told, that you should think about, well, we actually have to spend a lot more emissions to get to this green future that pays it forward. And that kind of makes sense to people, whether they like it or not. Like, oh yeah, you got to build some things to actually do that. And building things is emissions. So one way or another, whatever way you measure it. So what's cool is that maybe one of the few good things, maybe the only good thing that comes out of this whole crypto experiment of the last 10 years has been wrapping real world assets, carbon assets that are empowered by technology into a digital token so that you can easily buy and offset it. And more importantly, and we'll talk a little bit about this in a minute, is that that's sort of the missing issue with, from my perspective, from ESG investing, which is, yeah, you can produce a result, but if you produce too good of a result, it's suspicious. If your performance is too good, it's bad. And I understand why that is. But if you had this action step where it says, hey, emissions are an expense to the world, and I can offset them and incorporate that into an investment process such that I can get you a better return, get you ESG metrics you want, and actually do something. And what that do something is actually a whole new portfolio of offsets, of projects, of various levels and of various focus to offset the return engine of your portfolio. And that's sort of the exciting thing. And what Rob and I were doing is saying, hey, if you take these broad indices that people know, so we talk about it in the piece, Spider, the Russell 3000, Rob's bringing it up now. You can, using a bunch of signals and some other things that we know how to do, you can create a portfolio, and then you can calculate the emissions and offset it. And depending on the price, and we show this at various prices, so we certainly show the digital carbon, which is the cheapest price, but we also show the nature-based offsets, and these are offsets that trade over the counter and have for many, many years. And they are trading at prices that still make it feasible at that 5 to 10 basis point sort of cap to be net, either 100% net zero or definitely 50% net zero. And it depends on how the investor wants to go. What it then creates is a much better and real conversation from an investing standpoint, where emissions are an input no matter what in an investment process, because there's a cost associated with it. And if there's anything that's going to move these markets forward and sustainability forward or any of this stuff, is there's a cost associated with it that actually is integrated into a process. And I'm not suggesting that consumers necessarily need to bear that cost. I'm suggesting that investors need to bear that cost, or can bear that cost. And increasingly that cost is a cost that is in the investment process. Because if we go back to sort of stock A, B for that active manager, efficiency is part of it. It's not number one. It varies all over the place. We build statistics that are looking for what are the best relationships now. We're not stuck on the narrative that, low carbon's good, high carbon's bad, or whatever your thing is. And if you actually believe in that, what's funny about that is that basically low carbon, high carbon, right? So like energy companies on the high carbon, tech companies on the low carbon. It's a relationship that generally works for like 8 years, that the low carbon guys win. And we only have about 20, 25 years of data on this. But when they reverse, it undoes all of the 8 years of performance every time. And it just happened the last 18 months. Energy went from being its lowest rating in the S&P 500, not to the highest, it just doubled. And it went from like 2.5 to 5. And all of the tech stuff went down. And that was just that 10-year cycle all over again. It happened in 2008, and it happened now, and it'll happen again. And it's just a cyclicality thing. It's not an ESG thing. It's just, but when you start looking at the market in lots of different functions, it helps confirm turns and cycles. And it's just like, it's why you have to pay attention to things that are a pain in the ass, because they end up mattering. And
that's a good,
yeah. So
that's a good point. You have 25 years. You said you only have 25 years worth of data. So the more data we get, the more better analysis we can do down the road. But that's a very good point about just the really relatively short amount of time we've had for this data. But already we can see some of that cyclicality in that.
It just reinforces. I would say it just reinforces something everyone knows, but needs to be reminded of, is that there's a cycle all the time.
Yeah.
And it's longer than you. It's basically what it comes down to.
Very true. Very true. That's great. Really quickly before we move on to our last few questions, I do, Rob. I think I want Conor back as a repeat guest, just to go into the whole blockchain, subject. I think.
Well, we have also. I'd bring others. There's better folks than me. I can see how it can be used in the efficiency, and but also it's really just a market structure too, that this particular asset class has a very good profile for a registry blockchain type setup. And when it's empowered with technology, measurement technology, it really does become an asset class. And over time, not in the US yet, but over time, we believe that the voluntary carbon market, which exists now, will be more digitized. And because of that, it will be the on-ramp for financial services to sort of link it up and integrate it into indices and into products. That's right.
The immutability and the transparency of the blockchain are two things that we won't go down that rabbit hole now. I know, but let's have you back to talk about those things, because I think it is.
Maybe we'll bring some special guests too.
There you go. Yeah. Yep. All right, Rob, back to you.
Yeah. So going back to the original line of like sort of, and I didn't want to go all the way down the net zero, because that's a whole nother discussion.
Fair enough. Yeah.
But the idea is we're working towards leveraging the market to reduce emissions on some significant, meaningful scale. And so I'm going to bring up this next slide. Can you talk about how sort of what carbon pricing is in this context, and more importantly, how we can use it to drive this change and why we should be focusing on scope 1 and 2 to do so?
Yeah, perfect. So, so what this graph is about is essentially we have three different carbon pricing mechanisms. We have digital carbon, which is a weighted price of about 5 or 6 tokens. The nature-based offsets, which are over-the-counter products that trade in the States and others. And then the California regulatory credits that are just used as a pricing mechanism. These are primarily the auction price carbon in California and other states that are for regulated emissions. So you wouldn't really ever buy these to put them into a portfolio, but corporations in the United States do. So it gives you sort of a US benchmark of an upper end of a price. What we're trying to show here is that for a variety of very well understood, widely held investment benchmarks, so the three in the United States would be the S&P 500, the Russell 1000, and the Russell 3000. And then outside the States, it would be the EFA index, which is the developed world index, and then the all country world index, which is just everybody. So on scope 1 and 2 emissions with digital carbon, which tends to be about $2 a metric ton, you are able to offset all your scope 1 and 2 emissions between 1 and 2 basis points. And that is really exciting. And even if you used the California regulated price, which is significantly higher, it would be 14 basis points for all of the various forms of the US market. Now, 14 basis points is too high for an ETF product. And that's an important thing for people to understand, is that in over-the-counter products, 50 basis points is the max you really can charge in a fee and be widely distributed. And you need to figure out how you get all your costs under that number. And the point is that perhaps not all forms of this can get to ETFs yet, but it's at the levels where it can get there. And it can get there now, and there's room for it to grow. So that's primarily the idea. Now, if you include scope 3 emissions in any of these things, it goes off the charts. And it becomes undoable at any price under 20 basis points. And that isn't palpable for a lot of financial participants. It may be palpable for certain private funds at first, but over time, everyone wants that number to decrease to some manageable level. And for the audience at home, that management level is somewhere between 5 and 10 basis points. Because what ends up happening is, if you have been following this, you have essentially the ability to create a separate and distinct portfolio of offsets. So we create a portfolio, we take an existing portfolio like the S&P 500, and we then create a portfolio of offsets that effectively eats the emissions of your ETF. And you can do that. And what I think happens from that in terms of sustainable investing is that really unlocks the market for it. Because now there isn't this sort of unfulfilled action step. You know, sustainable investors I've met over the last 8 years are very complicated investors because they absolutely want returns. In fact, they're the most hungry for returns.
That's not to interrupt, but that's such a key point. They need, without the returns, there's not really a mark. I mean,
there's not a mark.
That's the distinction. That's the inflection point.
Yeah. And they know and have known, because certainly 8 years ago, you were even more of an outlier than perhaps you are now, but they knew that they were, quote unquote, tempting the gods to take money away from them by being good or whatever it is. And what I would say is that what it just means is that if you want to do both at once, you have to develop a really good investment process that accounts for it. And it's a pain in the ass. And I've been at it for a long time. And but it does create a much better outcome, whether you care about sustainability or not. And the reason it does is because this is how these things trade. you know, so it's one of those things where it doesn't really matter what you think about it. If you're going to invest in them, you better be aware of this. And obviously, it can go both ways. I don't want to bring up all the topics in the news, but I mean, you can see how vulnerable brands are when they compete against other brands if they make a misstep.
Yeah.
And you know, it's true in consumer, it's true in tech. You could have been short Facebook the whole time it was going down, just on ESG concerns, and you would have been right the whole time, by the way, because they were selling their data, unlike what they were saying. So, I mean, it's the other thing I would say is that ESG should be a place where more short sellers should be, because it's a data set that's overlooked by the bigger groups, and it can be used to, married with other things, it can be used to ferret out a lot of stuff. As we all know, the facts don't matter until they do, but it's good to have a nice list of stuff that could be impacted. So, and we had talked, this is a subject for a different time, but like our signals caught a lot of this banking stuff, but not because those signals know anything about banking. So, and I think that that's kind of the point, is that you need to employ different things that are looking at markets in different ways. Now, they need to work, but you also need to use them and integrate them into a process in order to outperform.
Yep, that's great. And I think it goes back to what Rob and I and the whole OWL team talk about all the time, is in order to do exactly what you just talked about, you have to have good, reliable data, and it has to be as fresh as possible in order to make these decisions, right? What are you going to buy? What are you going to sell? What are you going to short? All that information needs to be as near real time as and quality as possible. So,
and it's got to be consistent. Yeah, I mean, you guys are consistent. I mean, for the investors at home, what you guys do is normalize earnings or normalize ESG data, and that's a big thing, because there's huge variance between providers. That's great, right? There's huge variance between analysts on stocks, and I spent a number of years just using that as an indicator to how to allocate among sectors and industries. It's pretty effective, actually, and pretty straightforward. So
yeah, that's great. That's great.
Well, all right. So we always end with the lightning round when we have guests on. But before we get into that, one last question, because we're working on something now. So what's next? You want to talk about
it? So we've almost touched upon it a bit. So what happens if you take these same indices and you attach a dividend to it, right? So you have a bunch of stocks with dividends. So what Rob and I are working on now is essentially an article that says, let's look at 4 large dividend ETFs by the providers here in the United States, just as a proxy for a dividend portfolio. Look at those portfolios through an emissions profile, which is actually pretty wild, because you see how how different they're allocated and the potential risks involved. And then you compute the net zero cost of zeroing out each one of those portfolios. And we take it a step further, which will be ready next week, which is, okay, we take that same universe. If we were to optimize for it using our signals and some other things, what would that look like? And so that's the main heart of it. People love income, and income investors are primarily in cyclical industries with interesting emissions profiles. And this is a data set that can help enhance that experience, independent of whether you're sustainable or not. But it also is a very good proxy for what the average person is trying to do with an equity portfolio. They're trying to own a lot of stocks, they're trying to have an income with it. And what would that cost to be sustainable in terms of an emissions profile? And if you had a cost of emissions, how would that change how you'd even construct the portfolio in the first place? And what would happen likely is that you would end up owning all those cyclical industries, but you would own them in a more effective way. It would be my point, which would be, hey, each dollar of yield you're getting, you're comparing that to whatever equity risk models you're employing. You're also looking at that in terms of your cost to own those emissions. And it's another risk factor that can be integrated into your process to optimize how you do it. Or in the case of Confluence, we optimize around that. And I think it starts to unlock these, very straightforward questions that people have, which is, how can I get income and not be in 100% utilities or fossil fuels? But they're not saying, hey, how can I create income and not be in any of these things? Because actually that leads to an answer of, you can't create a lot of income without cyclical industries. So it becomes an investment discussion. It becomes a good investment discussion for sustainable investors and their advisors. I'm not suggesting that they have all the tools yet here, but I'm saying that, you want to own some Exxon or some Chevron because you can offset that and it's paying you 5 or 6%. And, but if you don't want those companies, then you at least have a list of the companies you could have that pay you a dividend. They all have emissions attached to them, though. So it's just a question of what you want to get comfortable with. And in the end of the day, that's sort of why I say, create a portfolio of returns, have it all be transparent and with all the data so that the ESG profile is very clear, and have a very high, attractive ESG profile. But in addition, you can have a healthy return and a good return in yield. And that's really the missing piece for sustainable investing, is saying, well, these are costs. And sometimes, like any investing, you want to be overweight those costs or underweight those costs. And I would say, I know it was one of the questions, like, where is ESG going? I would say if it's a factor, it's mated when people can be underweighted for a period of time because the returns aren't there. But that the notion is they'll be overweight when that matters. And when that's the discussion, then it's beyond mainstream. And I mean, we're trying to push it that way. Yeah. It's just part of the way. And I don't think we're that far away from looking at, okay, I can get this yield for this amount of admissions. I can get this yield for this amount of admissions and this risk. That's what people, that's what people want. This is what the cost is. These are what the returns are. At the end of the day, our job is to do both those things, but to generate a return. And this gives the tools to the investors going forward and hopefully some of the products to do that. Because, I think we all have kids on this line. I mean, like, my kids just want this stuff to work. And they kind of are wondering why, like, everybody seems so childish. So, and I don't know, I didn't think they're that far off, unfortunately. So, anyway, but it creates a much better discussion for us as sustainable investors. And then it links it to, I think, the thing that the end user has been wanting, which is, make this work for me. Because I'm putting $100 in and I need it to be X at the end of this experience. And I want that experience to be better than what it has been. So, it's been fun.
Yeah, you hit the nail on the head. I think, and we talk about our children and the younger investors coming through do want that transparency and ability to make the choice based upon the data that's out there. So if we give them that data with that transparency and allow them to make the decisions based upon their goals or their what they want to have an impact on, then absolutely. So 100% agree.
Well, and it just becomes another market. I mean, the reason this probably will work is because it's another market, and we're in the business of expanding markets at the end. And like, that'd be great. I mean, a market-based solution for sustainability means that actually it'll get fixed.
So, all right. Now we jump into the fun part, the lightning round. Do you want to kick us off?
Yeah. Well, I'm going to choose favorite book.
Okay.
I love reading books, so favorite book. Any topic, any genre. So yeah.
Yeah, my favorite book. I mean, there's a few, but the one I immediately thought of was Confederacy of Dunces. It's a great book. It's a funny book. It's a book that'll make you laugh out loud. It was written by a guy who is from New Orleans. It's all about New Orleans. And the guy, unfortunately, died before it was ever published. His mom published it. It's referenced a lot as a sort of
it's a crazy
writer.
Story. He died by suicide.
Crazy story. Yeah, he did.
His mom found the book years later and brought it to a professor. The professor wrote the foreword. It's one of my favorite books too. That's all my smile. The professor said, "I'll read it for this grieving mom," and basically says in the intro, "I didn't want to like this book. I wanted to write it off." And by the time I was finished with it, I was like, "We need to publish this."
Oh, yeah.
Wow!
It's a funny book. It's a book that will make you laugh as you read it. It's also just really well written. If you've been to New Orleans, it's a whole thing. And then the story around it all. There's a statue of the guy in New Orleans. Yeah, it's a great book. Great book.
So can you say the title one more time for me and for
our Confederacy of Dunces is the title. And
O'Toole is the author.
It is. I want to say O'Toole. John Kennedy O'Toole is probably not correct, but I think that's the author. And I have it not too far from where I'm sitting. So
all right, I'll have to check
grab it afterwards.
Nice.
I got a big smile for that one. My literary nerd is up, but I gotta. All right. What's your favorite pizza topping?
So Friday night's pizza night around our household. So I would say mushrooms, but it's tough to pick just one, but I would say mushrooms.
So are you a pro or con pineapple on pizza person?
I am not a pineapple on pizza person.
Ooh.
I like pineapple.
Right.
I don't like pineapple on pizza.
Okay. Rob and I are pineapple on pizza guys.
Yeah, we are.
Yeah. All right. Yeah. Well, hey.
Yeah. Hey. Yeah. Okay. Let's favorite sport to watch.
Favorite sport to watch is baseball. And I was saying before this that it's been awesome to be a Pirate fan this year because McCutcheon's back, and it's kind of, I don't know, it's just great. It's kind of very storybook for Pirate fans.
I'm going to go out on a limb and.
What's that?
Well, I was going to say I'm going to go out on a limb and guess you're an analytics person.
Well, that too, but this is just sort of the pure, like, it's just awesome. He's back, and he's going to, I hope, retire as a Pirate, and we're doing well. So, but yeah, it's my favorite sport to watch for sure.
All right. Next question. This is a little bit of a throwback, but we're not in our 20s right now. So GIF or GIF? I'm
a GIF guy. I'm totally a GIF guy.
Yeah.
I mean, I'm pretty much, I definitely was involved where you were just looking at it as a file name and you didn't get to see it until it actually showed up on your disk or whatever, and you clicked on it. I mean, it wasn't no mosaic, pre-mosaic.
Oh yeah. I'm definitely GIF.
Yes,
like GIF, that's too close to peanut butter. So GIF, that's what, yeah.
Yeah, GIF.
Yeah. Cool. All right. Ooh, this is a hard one. Subject in high school. That's a long time ago for a lot of us. Actually, if you could travel anywhere in the world, where would you go?
I would like to go to Vietnam or Thailand, or Japan. So one of those three. That would be great. Awesome.
Solid choices.
So what were your favorite subjects in school? And I'm throwing out high school and college.
Yeah, I was thinking about this. I liked, in high school, I liked history. In college, I think my favorite class was playwriting, but I don't do anything in playwriting. But I mostly, in college it was math mostly. So finance and math.
Interesting.
All right, superpower. Choose a superpower. What is it?
Yeah, so I thought about this a little bit. I guess my superpower would be flying because I'm afraid of heights. So if I could fly, I would assume that my superpower would overcome my fear of heights. So that's why. But if I can fly and I'm still afraid of heights, I'm really worried.
That's actually a great last lightning round question. A little humor, but also, I mean, this will be published in a few days, but Guardians of the Galaxy comes out today. So I am a Marvel fan. I've lost some interest, and it's not for I feel like there's been some saturation, like too much saturation lately. It's a lot to follow, but Guardians of the Galaxy, I'm a music nerd. For anyone listening, Guardians of the Galaxy 1 and 2 have two of the best soundtracks ever. I mean, they're amazing. So I'm looking forward. I will be seeing Guardians of the Galaxy 3 tonight and giving the futuristic implications of the technology in that. One final thought to leave us with before we go. Where do you see ESG investing in the next year, 5 years, 10 years? It doesn't have to get crazy analysis, but just like.
No, yeah, I think it's kind of what I said. I think it becomes this usable factor, right? That it's just part of the conversation, and it's not very political. It's just, okay, this is another factor in this, and sometimes we think it's being valued, and sometimes it's not, and that there's more action steps. There's more kind of intentional, you got to do this, you got to put a cost to that. I think that's kind of how it goes. And, the amount of data around sentiment, around emissions in the scope 3 lands and beyond. I mean, there's a lot of white space for people to do some pretty incredible stuff. And not to mention all the people building companies, that part of it, how they implement the S, what we've seen, we didn't talk about this too much, but the S variable, the most fuzzy of the variables from a quant perspective, ends up yielding a lot of value, in part because it's so fuzzy. And the S component is a critical component depending on what industry you're in. So there's going to be, and is, more activity around that and how to improve teams and groups. So it'll be exciting. That's what will definitely be the case. And there'll also be lots of controversy along the way, and we'll be taking politics out of the boardroom and then putting it back in, and then, whatever else. So
well, it's the American way. It's the American way. Politics in, politics out, right?
It is.
So,
all with the US dollar. So
there we go. No, I love that answer. I love the data part. Obviously, we feel like we want everyone to come check out Owl's data. It is the most accurate, the freshest data, the most transparent, the most objective. Conor, thank you so much. This was a wonderful discussion, really informative. I love this stuff. So many angles to dive into in the future. So I'm gonna start sending you invites because I really want to have you back.
Yeah, Conor, thank you. I learned so much about your company and about especially the carbon credit. So thank you so much. Appreciate that.
No problem. Appreciate it, guys. Take care.
Ladies, gents, children of all ages, thank you so much for joining us today. This is Rob Yates, Armchair ESG with Nathan Yates, signing out. Have a wonderful rest of your day.
Goodbye.